It's B of A's shocking email. I'm Steve Van Metre. The pros are selling, retail's buying, and markets are crumbling under the weight of the tariffs. Who's got this right? You won't believe why what the big bank says is coming next has left me speechless. Now let's head over to B of A's Global Research, where we picked today's story up with the flow show from Goldilocks to Gold Eye Lots, as everybody now is overweight gold and in a major way. In fact, fund managers are now saying that that is the biggest risk to the markets now. It's the most overweight trade. Love to know what you think. Hit the comments below. Are you buying or selling gold here? Because the fund manager survey from April now is the fifth most bearish in the past 25 years, as price action around the four prior big sentiment lows. Cash level says always a rally. So check this out. Remember, retail's buying here. The pros are selling, but you're going to be shocked to see what the pros are going to do next. We see going back to March of 2001, October 2008, June of 2019, and October of 2022. Those were all tradable bottoms. Meanwhile, the pros were dumping stocks at that time. Let's take a look, because investor sentiment now from fund managers is the fifth lowest on record. And usually when this happens, this is where opportunity starts to knock, because what's happening here is fund managers are dumping stocks, they're raising cash, and as soon as things turn around, well, guess who's going to play chase to the upside? But is this the time to buy? Well, wait till you see what Bank of America had to say. Because cash now surges to 4.8%, the biggest two-month jump since April of 2020. Now, you'll note that fund manager cash really needs to be above 5%, but if the tariffs come down and fast, watch these fund managers come back into this market, and in a big way. As a record number of fund managers not only are selling stocks, but intend to further sell equities here. What do you think? Is that a smart move by them? Weigh in the comments, because let's take a look at positioning here. Again, we mentioned that retail is buying here, because what we're seeing is investors are extremely emotionally bearish. They're saying they're bearish, but they're not physically bearish, meaning they're not selling. As B of A notes, their institutional and private clients have not sold much, but that could change, and I'm going to show you why here in a bit. Because what B of A is suggesting is sell into any strength. If the market rallies, you need to sell, and look for 5,100 on the S&P to be a buying point, or go big on 4,800. But I want to know your targets. Weigh in the comments below, because B of A is also saying go big on the long bond, that is, and long gold to play a dollar bear market. Again, I want to know how you're trading this market. Weigh in the comments below, because in their latest report, they also cover the trend following CTAs. And what we can see across the three major U.S. indices is their net short. And I'm going to show you where the trigger points are, because not only are they short the equity market, they're short the commodity market as well, suggesting there could be some major opportunities. And we're going to look at that here in a moment. But let's turn to Goldman, where we really get a clear picture of the CTA positioning and what's coming for the markets next month. Because when we look at their CTA positioning, what do we see over the next week? Machines still net sellers, but look at this, 7.4 billion to buy in the S&P. So not only is retail buying, but the machines are buying as well at the same time. Fund managers saying, look, not only do we want to sell, we're going to sell even more. But here's the big number over the next month, and this is going to be important as we move into May. What we can see is 67 billion to buy. This is of global equities. Out of that, 23 billion in the S&P 500. Now let's take a look at these pivot levels. These are key. So if you're taking some notes here, you want to keep track of these, because this is very important to understand that these are the levels where we're going to see the machines buy. So the first pivot level here is going to be 54.79. So if you see a close over that, look for the machines to cover those short positions. The next level up from there is going to coincide right around that 50-day moving average in green that's trending down. That's at 56.51. So the first hurdle has to be broken here, but there's a big problem with the market structure right now. We'll look at that here in a moment, but let's continue on, because I want you to understand that even though the pros are selling here, it's what the machines are going to do that's going to make a big difference. And here you can see CTA positioning. Again, these are trend following machines. When price goes up, they buy. When price goes down, they sell. They follow. Again, they're momentum traders. And you can see their CTA positioning right now is at some of the worst levels in history, meaning they could sell even more. But the big move they're going to make is they're going to become buyers at some point. But what could push the market higher, particularly going into next month? Corporate share buyback blackouts are coming to an end starting on April 25th. That means the open period begins. Now keep in mind that doesn't mean everybody's buying here, but looking at this chart down here, what we can see is as we move into May, more and more companies come out of their blackout period and are expected to be big buyers of their stock that could push the machines into a mode of their buying, not to mention force fund managers out of those cash positions. So again, we started the show out who's right, the pros or retail. I want to know from you. Weigh in the comments. So now let's take a look at the technicals, momentum, and machine positioning across the broad equity, bond, currency, and commodity markets, just like we do every Sunday, because I want to show you where the opportunities are in this market and what you want to avoid if you're looking to get back in. Let's start with the S&P 500 because I want to look at breadth, and we're looking at a long-term historical picture of market breadth. And what we see right now is about 31% of the S&P is trading above its 200-day moving average. Now the issue here is we've seen this only improve slightly over last week, but notably I've circled all the places where breadth has indicated a potential bottom in stocks, but notably it doesn't just stop at one point. So what you see here is stocks come down and they settle a bit, and then breadth takes off. So based on breadth alone, this doesn't give us a clear picture. So let's take a look at, again, the machine positioning and momentum indicators along with the technicals. Let's see what's going on with this market and if you should be buying or holding off, because I'm going to show you there's some potential opportunities that are knocking in the near term here. Right now we see momentum negative. Now how do we know that? We look at the technical indicators. This is a relative strength indicator. We want it to be above 40. It's at 42. The MACD's got a positive cross. It just turned that way. But the question is, why is momentum to the downside still? Well, one of the challenges in trading momentum is it can get oversold, but price can continue to fall and then flip back into oversold condition. So you need to pair it with the trend. Now we do that with our own Momentum Timer Pro report. Right now it's flagging 40 consecutive daily sell signals. Our 1 month window is at a sell max. So when this flips, our subscribers are going to be all over this. Not to mention, we run a mimic of the machine positioning on a historical basis. So here you can see the fast algorithms, max short, while our subscribers or a CTA Timer Pro are going to be big buyers when we tell them this signal flips. Now, if you want to know how to trade these signals, grab the links in the description below. There's a free 30-day free trial because it'll make perfect sense. If you're looking to get back in, we're going to give you the edge. So right now we have no position on this. Let's take a look at the charts because I want you to see what's going on here and why BofA says that, look, this can come down even more, and they're absolutely right. Let's take a look at this 6-month chart. You see the volume profile here. Sellers were above that, and as soon as we saw the trade war start to heat up, everybody was selling. Well, that is, retail came in and bought this dip. So we can see the SPY came down to around 480, but look at the 21-day moving average here in red. And this is key to understand because notice how the market's been following that down. Now you see the 9-day creates some false signals here as it tries to rally up and gets rejected against the 21-day. But let's zoom out to the 2-year chart because what I want you to see is that tradable bottoms don't actually form until you're starting to see price rising into the 21-day moving average. Now, are we there? No, but we've seen this happen before, and it's very clear as we see every time the market rallies up, what do you see? Selling here. So what BofA is suggesting is it's likely to come down a bit more, but if it comes back down to around this 480 to 500 level, that's where you want to be a huge buyer. Now let's talk about tech stocks here. We see the same thing, a potential tradable bottom in breadth, but notably we've seen points where it does get worse, where the market still needs to come down a little bit more, and that's one of the key things we're going to be watching in earnings season, because at some point a lot of these tech companies are going to have to justify their AI spend. They're not there yet, but we could see some alarm bells ringing during earnings report. Let's take a look at our screens here again. Momentum is still negative. The technicals have turned up, but the price has not validated that. You can see our machine positioning suggesting buying here. We did not tell our subscribers to buy into this. I'll show you why on our charts. Let's flip over to the QQQs here because I don't think the opportunity is in the big caps right now. And again, you get this clear sign. The 21-day moving average is acting as a guide lower. It rallies up, gets rejected, rallies up, rejected, rallies up, rejected, suggesting again that there's got to be some more downside here, and then you have the potential for a double bottom, not just in the S&P, but in the NASDAQ as well. Now, we talked about how the Russell 2000 could be one of the biggest opportunities because check this out. Only 17% of it's trading above its 200-day moving average, and it was about 15% last week. We're starting to see breadth settle here, which is a good indicator, but it doesn't mean that that is the absolute bottom. There looks to be a little more dust to settle, but this is the one you really want to have your eye on. We've got 42 consecutive daily sell signals, but again, we saw momentum turn up, and it's looking like it may roll back over. Machine positioning, max short. Again, we're max short across our short-term momentum indicators. This is not yet a buy signal, but we're getting pretty close to that, particularly if there's some news that changes the scenario. And let's zoom out to the 5-year chart. And what are we seeing here? A big move down into the zone of support. So again, if we see another move down here, it's a strong indicator of where you might want to look to get in. Now, let's zoom out to the 2-year chart. What do you see? These two purple bars? This is a supply zone. Now, supply zone are either where people want to buy or sell. And so far, this is where we've seen people sell. So the indicator here suggests that if sellers dominate, it's going to pull down to this 170, maybe into the 160 level, and that's really where you want to look to perhaps take a long position in small caps. Particularly, there's one thing that people don't realize happens during early stage bear markets. If indeed that's where we're at, it's called bear market rallies. That's when you see, of course, machines get squeezed, fund managers get squeezed, and everybody comes surging back in. And then, of course, the news and the market drives things lower, but it can be a very strong opportunity. But let's talk about something that I see here in the near term, and that's crude oil. Now, this hasn't flagged on our reports, but what we're seeing here from the experts, and I want to look at the charts, and I want you to see what the news is saying, the experts are saying, but more importantly, what the charts are saying. The reality is, in the big picture, we're very well supplied, so if those sanctions don't come into play or those entities find ways to get around them, which has kind of been the MO for these type of things, crude oil prices should continue to make lower highs and lower lows. Let's take a look at our screens here because momentum is negative here. We haven't seen the technicals really pop yet, but I'm going to show you the charts. It gives you a completely different story. We've got machine positioning max short, and this is huge because machines are big traders of oil. And if you get any news that says machines are buying, well, you might want to look at going into this sector, and I'm going to show you why they're probably going to be buying soon. We see our Momentum Timer Pro all across the board sell signals here. But let's take a look at the chart of XLE because this is very interesting compared to what you see in the S&P and the NASDAQ. Now, you see a lot more volume traded here, and you can say, well, wait a minute. It looks like the price came down just like the major indices, and then it rallied up, and it hasn't gone anywhere. But remember, the major indices, what did you see? A lot of red candlesticks. What are you seeing here is people are buying in the energy sector. And then let's zoom out, and I'll show you why, that this has been a zone of support for the last 5 years. Remember, the pros, the insiders, they sell high and they buy low. Now let's zoom into the 10-day window. I'll show you why I think there's opportunity here. Here's the 10-day volume profile. Clearly there's buyers underneath here, so somebody thinks that energy prices are going to go up and squeeze higher. If they trigger the machines to buy, you could be seeing a move right up here into 90. This would be a very strong play. It hasn't triggered yet, but I think it's something that could trigger in the near-term future. I want to know, what do you think of my take on the energy sector? Is it a buy in the near term, or are you sitting that one out? Weigh in the comments below. Well, Bank of America says you should buy these 5 bank stocks with upside ahead of earnings. We could not disagree more, and I'll show you why the charts are telling us. Let's take a look at XLF. This is the large financial ETF, and what do we see? The RSI is at 43. MACD's got a positive cross, but the trend says don't buy it just yet. Let's take a look. Machine positioning is covering off of his short position, and we see momentum is still squarely to the downside. But let's take a look at XLF here and see why I'm saying I don't think this is a buying opportunity, and here's why. Look at this supply zone, and this is very clear. Let's zoom out to the 1 year, and what do you see? Price rallied up into the supply zone and found sellers, and then it gapped through and then took off, pulled back, and those sellers now found this zone to be a place they wanted to buy, and then they wanted to buy again, and now look what's happened. Price broke through there, so all these prior buyers were then upside down on their trade. What happens? Price rallies back up into that zone, and what do? They want to get out, and you can see selling here suggesting to me that the next direction for financials is not to the upside, my friends, clearly to the downside. Let's talk about Brazilian equities. We mentioned that this has been a great trade for us. We're not in it right now, but it could be another opportunity. Let's see what the charts say, because right now momentum is turning up, at least on the RSI. MACD still got a negative cross, but what we're seeing is some buying from the machines here. Let's take a detailed look at the chart. Price hit a low, rallied off of that. This is one we traded and made some money on. Pulled back into a level of support, rallied up, got rejected the 200-day moving average, pulled back down, looked like a potential bottom here as it came into support. But here's the issue. It rallied right into the 6-month volume profile and got rejected. So right now, we'd be looking for Brazilian equities to come back down. In an ideal situation, we want to come back down to this 24 level and form a left shoulder ahead, a right shoulder, and that would be a catalyst to break back out, retest the 200-day moving average, and perhaps go even higher from there. So that one should be on your watch list. It's not a signal yet. But remember, the pros said buy emerging markets, and we said, well, not quite yet. Momentum is still negative. We're seeing the RSI and the MACD turn higher, but we're not seeing the trend validated. But there is machine buying here. So let's take a look at emerging markets, because what's important to understand about emerging markets is they're a proxy for liquidity. So when liquidity comes back, they tend to go higher. But what are we seeing here is some risk. Price rallied up, and what happened? Found some selling here, pulled back, found some more selling, found some more selling, right into the zone of volume. That was a prior level of support. Tells me the people that were buying in here are now looking to get out. So I say this is not an opportunity just yet. Liquidity conditions haven't fully turned around. But remember, Bank of America says go big, and go big the long bond. But is it time to buy TLT? I don't think so. Remember, we did get stopped out on our last trade, so now we've cleared the deck here. We've got 9 consecutive daily sell signals. We've got a max short on our fast algorithm. We see there's some buying on the long-term algorithm. Remember, and BofA said on their trend followers there was a net long position still on bonds. Let's take a look here. Momentum again clearly negative across the 1-month window. Let's take a look at the charts and see, is this the time to buy TLT? Whereas Bank of America slightly ahead of on their signal, and I think they're a little bit ahead here, because we saw price come down due to hedge fund selling as liquidity conditions did drop. It rallied into its 9-day moving average, got rejected. Price tried to rally into it again, got rejected. I'd be looking for this to pull back down into around 86.39. If it holds this zone of volume here, that would be an indicator to look to buy with a move up to 90.05. So are we there yet on the long bond? No, we're not there yet. But what about gold? Well, price on that keeps going higher. Everybody is bullish. Fund managers say this is the most overcrowded trade, and yet momentum is positive. The RSI is at overbought territory. The MACD is at overbought territory. We're sitting this one out. We did make some money trading the junior miners, but a reversal at some point would make a lot of sense. Let's talk about the miners here, because what do we see? They broke through our upside target. We did get stopped out on our trade. We made some nice returns, looking to find an opportunity elsewhere. But let's take a look at GDX real quick and see if this is an opportunity. Well, you see price rallied up. It's now found some sellers here. Historically, if we go back on the max weekly chart, it could go up to 63, but if we look back, this is a zone where people have previously sold before, and you can see when that happens, price comes crumbling back down. So this may not be a point where you want to add, but maybe run your stop loss levels up and tighten them a bit. But how about the dollar? Is the world losing faith in the almighty dollar? Well, you can bet they are. Let's take a look at what's going on here. We see 34 consecutive daily sell signals, max short on machine positioning, max short on momentum. This is not a trade you want to be in to the long side, but at some point, it's going to be a potential opportunity when it does reverse. Let's take a look at the dollar, and then we'll look at our trade of Bitcoin next. And here's what we see with the dollar. It is likely headed down to 26.92. Nothing looking like it's going to provide any level of support here. We go out to the 5-day chart. What do you see? That is the next zone. After that, you're looking at 26.50 to 26.75. But how about Bitcoin? Remember, we put a buy order on that last week. What do we see? Momentum's negative. Our trade's up an impressive 0.01%. But keep in mind, we see momentum bouncing back and forth off of very deep oversold levels. Again, we think there's opportunity here. Let's take a look at the chart and why I still think we should hold on to this trade, because I think there's upside. But I want to know from you, are you buying Bitcoin, selling Bitcoin? Maybe you don't trade it at all, but look at this. You can see it bounced off its 200-day moving average once, twice, and now it's starting to bottom out on the 21-day moving average. You see the 9 days all over the place, and right now the 50 days acting as overhead resistance. Look for a rally into the 50-day. If it gets rejected there, that's okay, but if it pulls back into the 66 level and hold, look for this to break out to the upside to 77. So while retail is buying, the pros are selling. Who is on the right side of this trade? Well, for the moment, nobody's on the right side because we could see a further decline in equity prices, as BofA predicts. That would mean, of course, the pros are right, but if it turns around from there, it suggests that retail's on the right side of this trade. And if that pulls the machines in to buy, watch those fund managers play chase to the upside. So this is a market where you need to definitely be watching the energy sector and some of the other commodity sectors, because that's where it's likely to see the first moves before you jump in back into the mega caps. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.